Welcome everyone. I'm excited to kick off today's presentation with a focus on the smart money trend reversal strategy. This is all about understanding how the big players, or the smart money, change their behavior, what we call a change of character. Over the next few slides, we'll explore how to identify these shifts and leverage them to improve our trading decisions. So, let's dive in and uncover the insights behind smart money movements and trend reversals. Let's talk about change of character, or CHoCH, which is a really important concept in smart money concepts. Essentially, CHoCH signals a potential trend reversal, meaning it can tell us when the market might be shifting direction. This indicator is crucial because it highlights a critical change in how institutional traders are behaving. When we see a CHoCH, it suggests that the big players might be starting to move differently, which often precedes a significant price move. Understanding this helps us align our trading strategies with the overall market sentiment. In the context of our presentation, recognizing CHoCH can give us a valuable edge in predicting when the market is about to turn, making it a powerful tool in our technical analysis toolkit. Let's talk about the change of character, or CHoCH, and why it's so crucial in smart money concepts. Essentially, CHoCH signals a shift in how institutional players are behaving. When we notice this change, it often indicates that a trend might be about to reverse. This is incredibly valuable because it helps us anticipate upcoming moves in the market. By recognizing CHoCH early, we can adapt our strategies accordingly, potentially entering or exiting trades at more opportune moments. Overall, understanding CHoCH ties directly into the broader theme of reading the market's subtle cues and staying ahead of the crowd. It's all about spotting those key signals that tell us when the tide might be turning. Understanding market structure is absolutely crucial for traders because it helps us interpret the overall trend and make better decisions. When we talk about uptrends, what we're really looking for are higher highs and higher lows. This pattern indicates that buyers are in control, pushing prices upward over time. Conversely, downtrends are characterized by lower highs and lower lows, showing that sellers are dominating and driving prices down. Recognizing these patterns allows us to see who's in control of the market at any given time. So, grasping these basics of market structure is essential because it forms the foundation for identifying potential entry and exit points, and ultimately, for trading more confidently within the overall trend. Now, let's take a closer look at the transition from bullish to bearish CHoCH, or change of character. This shift is really significant because it marks a critical change in market dynamics. When the price breaks below the last higher low, it signals that the buyers are losing control. This isn't just a small dip, it's a sign that the trend may be reversing. Essentially, what we're seeing is a loss of buying momentum, and that can often precede a trend reversal to the downside. So, understanding this transition helps us anticipate potential market moves and adapt our strategies accordingly. Remember, spotting this shift early can be key to making more informed trading decisions. Understanding the shift from a bearish to a bullish change of character, or CHoCH, is really essential for us as traders. This transition happens when the price breaks above the last lower high, signaling that the previous downtrend might be losing steam. It's like the market is hinting that it could be reversing and heading upward. Recognizing this change early can give us a significant advantage, as it often marks the start of a new bullish trend. So, keeping an eye on these key levels, specifically that last lower high, is crucial in our analysis. Essentially, when we see this break, it's a strong clue that the market sentiment may be shifting from bearish to bullish, and we should consider adjusting our strategies accordingly. This concept ties into our overall goal of identifying trend reversals early to maximize our trading opportunities. Let's take a closer look at change of character, or CHoCH. This is essentially our early warning sign that a potential trend reversal might be on the horizon. It signals that something is shifting in the market's behavior, but it hasn't fully confirmed the new trend yet. Think of CHoCH as the first hint or alert that traders should start paying closer attention. Now, moving on to the break of structure, or BOS. This is where the market movement confirms the change. When the BOS occurs, It shows that institutional players are committed to this new direction. It's like the market has made a definitive statement, and this confirmation helps us make crucial trading decisions with more confidence. Connecting these ideas, CHoCH serves as our early warning, alerting us to a possible trend change. But the BOS is what confirms it, giving us that strong signal to act. Understanding the difference between these two helps us better time our entries and exits, aligning our strategies with the true market shift. This is key to mastering how to read market signals and make informed trading decisions. Understanding valid CHoCH rules from an institutional perspective is essential for effective trading. These rules help us recognize key market behaviors that truly signal a genuine trend reversal. When we talk about valid CHoCH rules, we're focusing on the specific patterns and signals that confirm a change in trend direction, rather than just temporary fluctuations. It's important to grasp these rules because they act as a filter, helping us avoid false signals and make more confident trading decisions. By mastering what makes a CHoCH signal valid, we can better interpret market movements and improve our overall trading accuracy. This understanding connects directly to our goal of developing a disciplined, strategic approach to trading based on reliable technical cues. Now, let's talk about some of the common mistakes retail traders make when it comes to identifying and using CHoCH signals. Often, traders can fall into pitfalls that lead to costly errors or missed opportunities. One of the main issues is misinterpreting the signals themselves. For example, they might see a change in price, but not recognize whether it's a true reversal or just a temporary pullback. This can cause them to enter or exit trades at the wrong moments. Another common mistake is misunderstanding the overall context or the strength of a CHoCH. Without proper confirmation and analysis, traders might act prematurely or too late. And finally, there's the risk of misapplying strategies, using a method that worked in one situation but isn't suitable in another. All of these pitfalls highlight how crucial it is to develop a clear, disciplined approach to reading CHoCH signals. When you understand these mistakes, you can be more mindful and improve your trading accuracy, ultimately aligning better with the overall goal of consistent, informed decision-making. Now, in this slide, we're looking at a systematic approach to effectively identify and trade CHoCH. The idea here is to give you a clear, step-by-step process that you can follow to improve your decision-making and, ultimately, your trading outcomes. By sticking to this model, you can reduce guesswork and make more confident, informed trades. So, the key points to focus on are understanding each step thoroughly and seeing how they connect to the overall theme of disciplined, strategic trading. Remember, consistency in applying this approach is what will lead to better results over time. This model is designed to be straightforward but comprehensive, helping you navigate the complexities of trading CHoCH with greater clarity and precision. Understanding how CHoCH, liquidity grabs, and order blocks interconnects is absolutely vital for traders who want to capitalize on high-probability setups in the market. When we talk about CHoCH, or change of character, we're referring to those pivotal points where the market shifts direction, signaling potential reversals or continuation. Now, order blocks are essentially areas where institutional traders have entered the market heavily, creating zones of support or resistance. These areas often serve as key levels to watch for entries or exits. Connecting these concepts, when a CHoCH occurs near an order block, it can indicate that the institutional players are actively defending or surrendering certain price levels. Liquidity grabs, on the other hand, often happen around these zones, where the market might dip below an order block to trigger stop losses, only to reverse quickly and take out orders above the block. Recognizing these interactions gives us insight into the market's true intent and helps us plan trades with higher confidence. So, by understanding how CHoCHs, liquidity grabs, and order blocks work together, we can better anticipate where the market might turn and set ourselves up for more reliable, high-probability trades. This interconnected knowledge is a powerful tool in our trading arsenal, helping us stay a step ahead of the market's moves. Understanding the change of character, or CHoCH, is absolutely key when it comes to developing an institutional mindset. What this really means is that we need to pay close attention to early trend signals, those subtle shifts that might indicate a change is on the horizon. Recognizing these signals allows us to adapt our strategies proactively rather than reactively. Another crucial aspect is the importance of considering higher timeframe context when making trading decisions. By zooming out and understanding the bigger picture, we avoid getting caught up in short-term noise and can see the true direction of the market. This broader perspective helps us align our trades with the overall trend and increases our chances of success. So, in essence, mastering CHoCH and interpreting those early signals within the larger context is what separates a disciplined, institutional approach from a more reactive, less strategic one. It's about being observant, patient, and always mindful of the bigger picture in our decision-making process.